Brian, let's get right into it. 48.1 on our November manufacturing ISM. Definitely a setback. Fourth negative number in a row. New orders lowest in 10 years. Only 5 of 18 industries reporting growth. And finally, this probably doesn't include the end of the GM strike. It had a huge effect on the market. As negative as some of the positives were of other ISMs that weren't nearly as bad as what we saw in the U.S. this morning.
No question, Rick. It was disappointing. I still think you have the trade resolution hanging over the market. Just too much uncertainty for manufacturers to feel great. We still expect ISMs to move higher and above 50 marginally over the coming months. But clearly, there's a lot weighing on the manufacturing sector and keeping growth subdued.
You know, last week we spent most of our time in the long end of the market with rates firm, but certainly not keeping up with the risk-on mentality of the markets. This morning we popped and we set back after the number, but we're firm again. Is the complex of interest rates around the globe starting to wake up to some of the paths being taken by the global equity markets?
We think a little bit. We're surprised rates aren't a little bit higher. It's interesting. This year's been a big rally, right? As long as you own something in fixed income outright, with the exception of some maybe energy and triple C names, you've done well. So I think people are still chasing duration. But to us, interest rates look low out the yield curve versus what central banks have done and what risk assets have done, especially in the last 2 or 3 months.
You know, with Christine Lagarde in Europe and this notion that fiscal will replace monetary, is this just a market hope? You know, I have seen no evidence that Germany is going to change its mind, although as the biggest economy in the Eurozone, it definitely seems to have a manufacturing issue, as all global car makers do.
It's hard to say. I think what central bankers are telling you is that they can't do it all themselves. They need help. So fiscal is the next major thing. You saw some European election results, which maybe suggest a movement towards more fiscal stimulus. But I agree with you, Rick. There's not any evidence to suggest there is large fiscal stimulus coming on a global basis.
And finally, so many things changed after the last ease on October 30th. Many comps go back right to the end of October. Do you see central banks in this pause that seems to be led by the U.S. Continuing into 2020, or does it all depend on the path of global equities? Your final thought?
It depends a little bit. We think central banks have done enough. They want to stay on hold, but obviously they're reactive if they need to be. They're not done. They're not out of bullets. They want you to know that for sure. So we think the Fed would like to stay on hold, but obviously it's path dependent. We need to see growth, ISMs pick up, and the like for them to be comfortable.